Gaurav Mashruwala joins us on this leg of the show to answer all of your investment-related questions. Gaurav, thank you so much for joining us. Our first question comes in from Nishant. He wants to know where he can invest 50,000 rupees a year for the next 30 years to get a monthly retirement income of 35,000 rupees.
So first phase is talking about accumulation, and second phase is talking about after retirement regular income. Investment strategy for both will be different. When you are accumulating money from long-term perspective, you look at asset classes which are growth oriented, like real estate, like gold and equity. Now amount he is talking about, real estate is ruled out because you can't keep buying and you can't pay for real estate in bits and pieces over the next 30 years. So he's left with two choices, equity and gold. Now, if he's conversant with equity market, he can dabble into it directly. Alternatively, pick up an equity mutual fund so that on every month you're doing a systematic investment plan into an equity mutual fund as well as a gold fund. After retirement, you should take out this money because after retirement you have three distinct requirements. One is liquidity, for which you put money, contingency money, you put in savings bank account linked to fixed deposit. For your growth, you put money into an equity fund or a gold fund or a combination of two. And for regular income, at that point of time, whatever annuity options are available, like post office monthly income schemes, resident savings scheme, that should be considered.
Right, and our last question for the week comes in from Saurabh, who writes in saying he's an engineering student. He can save about 15,000 rupees a month right now. He wants to know where he can invest this money to create a corpus to buy a house for his parents. Now that's a noble intention. He also plans to pursue his MBA in a couple of years and he wants to plan his finances accordingly. Gaurav, what can he do?
Now if 2 years is his goal, then debt-based instrument is his obvious choice because equity in 2 years could be highly volatile. If he is not in a higher tax bracket because he is able to save 15,000 but he has not said where is that money going to come in? Is it his parents are going to give it to him? Is he earning from somewhere? So ideally I would encourage, if he's in lower tax bracket, recurring deposit is a better option because recurring deposit currently are offering higher rate, almost like a fixed deposit. Debt funds could be a good option, but debt funds returns are not certain. They are tax efficient, but since in a lower tax bracket, that doesn't make sense. So he can lock into a recurring deposit offering 9 to 10% interest, and after 2 years take out that money for his education.